So we start with the backstop piece and then go on to the normal liquidity piece. In that picture that I showed you before, maybe I'll just go back and you can just remind you. This picture, okay, there's global money dealers and there's derivative dealers. So now I'm going to talk about what is the liquidity backstop for them in case of a crisis. So now I'm just showing, stacking them. So there's the global money dealer and here's the derivative dealer. So these are just the same balance sheets, but now I'm adding a liquidity put here, a liquidity put here, and putting those as contingent liabilities of a central bank somewhere, or a consortium of central banks, because this is a global system that we're talking about here. Okay, this is more or less inevitable. I mean, the liquidity provider, dealer of last resort, is this bit here. This is the new bit. The liquidity put, funding put, this is lender of last resort. This is familiar from Badgett from 1873. Okay, we know about this. The new bit is this, is the backstop for prices in the capital market. And I'm putting those on the balance sheet. And this is an idealization and it's an imagination of what it would be like if we had only shadow banking. If we had only shadow banking, the role of the central bank would be to backstop the shadow banking system, because that's the only system we have. Okay, and here's how you would do it. So now I'm going to show you something. I'm going to show you the balance sheet of the Fed, and I'm going to show you that the balance sheet of the Fed right now looks like that, actually. That in fact, what the Fed was forced to do during this crisis was to behave like a central bank backstopping the shadow banking system, my idealized shadow banking system. You saw before that picture of the Fed and its balance sheet, the assets blowing up, the liabilities blowing up, okay? The end of that period, December 15th, 2011, this is what the balance sheet of the Fed looked like. Okay, this is, if you actually just downloaded it and from their weekly H41, which I showed you in the very first lecture of this class, okay, this is what it looked like. There was like $1.7 trillion worth of long-term treasuries, and there was almost $1 trillion of mortgage-backed securities, and so these are and GSE, so Fannie and Freddie liabilities. And this was all funded by $1 trillion worth of currency and $1.6 trillion worth of excess reserves. So in normal times, there was $50 billion worth of reserves, then it expanded to that. Now, that's how the balance sheet looks. But let's think about the risk exposures. So just do a little manipulation, a little adding to both sides of the balance sheet. And that's what this is, this restatement. So take that MBS GSE position here, that's your risky security position, and pair it with $0.9 trillion worth of long-term treasury bonds. Okay, same maturity as the mortgages. And then add 0.9 on the other side. So your total T-bond is now 2.6 instead of 1.7. Pair that with 2.6 of treasury bills and add 2.6 treasury bills on the other side. Okay, so we're just adding the same thing to both sides of the balance sheet. It doesn't change anything, net exposures at all. And I've added currency and reserves 2.6 so that you get 2.6 there. So I've consolidated them into one item. Now what I want to observe here is, and I put these in brackets because we're used to this now in the class. When I put them in brackets, that means we're talking about a swap, right? We're talking about parallel loans and their swaps. And what kind of swaps are these? Risky securities, T-bonds, that's a credit default swap. Okay. Long-term bonds, short-term bonds, that's an interest rate swap. Okay. And this thing here, T-bill currency reserves, this is like the overnight index swap, okay, that I was showing that blew out during the crisis. Okay, because you got 3-month money here and you have overnight money here. So this is sort of funding swap. This is the Fed acting as these out of the money liquidity puts, okay, came in the money, and so the Fed has them on its balance sheet now, okay. And it's even though we thought the Fed had tripled its balance sheet, if you really were to put these on the balance sheet as parallel loans, it's actually $6.4 trillion, okay, worth of nominal exposure in the swap market. And so it's acting as a global money dealer, okay, backstopping the money dealer part of the system, but also as a global derivative dealer, okay, backstopping the derivative dealer part of the system. It's not actually holding these swaps, okay, but its risk exposure is identical to what it would be if it was actually holding these swaps. The Fed was, so it's this sort of observation that makes me think that thinking about the world in this way as if it were only shadow banking, or as if shadow banking is the core of it and everything else is kind of less important. It's around the edges. We need to understand how the shadow banking system works, because that's where prices come from, okay? There'll be traditional banking, but it's not going to be at the center of the system. The shadow banking system is the center of the system. It's the wholesale money market. That's what we have to understand. And this is a little piece of evidence, a little anecdote anyway, that says that this isn't completely crazy. Okay, that what you would expect the central bank to have to do to backstop a collapsing shadow banking system is exactly what it did do. I think we're living in a Bagehot moment, okay, where the role of the central bank is fundamentally shifting, and we need to shift a lot of our understanding of monetary economics, how monetary policy works, how bank regulation works, and we have to start more or less from scratch and not just take things over from the traditional banking system, not just take things over from what we really refined notions of monetary policy, inflation targeting and all of that, which were designed for a previous banking system. We have to start from scratch. And the two places that I now want to talk about are systemic risk, okay, so backstopping, as it were, say a little bit more deeply about that in theoretical terms, and then normal liquidity risk, so not helping us from a crisis, but just sort of greasing the wheels, making where's the system where's a system like this my idealized shadow banking system, where does this system run into trouble? So those are the two. This is an attempt to create a language and a frame for thinking about regulating the shadow banking system. Right? If you had only a shadow banking system, I am not of the mind, okay, that money manages itself. Bagehot said money does not manage itself, and Lombard Strait has a lot of money to manage. So I think that's exactly true today, just exactly true today as it was 1873. But how would we manage it? If we had a shadow banking system, how would we manage it?